We have Taher Badshah now joining us, Chief Investment Officer at Invesco Mutual Fund. Now, the question is right on the top of the screen, right? Small caps and micro caps. And it's a question, are they in a frothy zone? Is it time to be cautious? And I think, if you just have to go to social media, there is all kinds of fears debate going on. Well, and of course, so much data that it'll make your head spin. But some of it is pretty clear that we are in a very, very strong bullish kind of a phase, Taher. The point is if one has stayed invested in the market over the last couple of years, one has made money, right? The idea behind doing this discussion was also to kind of convey to the viewer that now is not the time to start doing not sensible things, to get into things you would not do normally, because markets have this tendency, especially when they're in this euphoric zone, to suck you in. That's the nature of things. So just your thoughts, Taher, in terms of what you'd like to tell viewers and how to approach things. Go on.
Yeah, so morning, Prashant. So, I'd like to react by saying that, 6-8 months back, when we were talking about small caps and propagating that proposition, it was relatively easier. It is not that easy. I would agree with you. But the thing is that, we also do not want to look at this in isolation, and particularly my own. I'm evolving in my own learning, and probably, what I'm debating right now in my own mind is that it may not necessarily be the best way to just look at indices and the way they have moved in isolation and probably make a decision. I know that there are a lot of other, indicators which also suggest that there is a certain amount of frothing up, and it is there. There are certain pockets which are clearly extended. But I think it is important to keep the economic background in mind as well. And there are things which are happening out there which are still favorable. And as of now, it doesn't look like we have too many deterrents in the way to disrupt that proposition. So I think it is we have to be judicious. We have to be a lot more discerning about what we actually do and what we don't do. But I think we can't take away or wish away the fact that there are pockets of the economy, many parts of the economy, not just pockets, which are doing well and perhaps may surprise in terms of earnings as well. So what then appears to be apparent valuations versus real valuations, there could be a difference because you might actually end up having a fair bit of earnings surprise coming along your way. So that's how I would like to probably describe the situation. So it's obviously something that you do a lot more gradually now. You don't have a choice but to be a lot more pickier because the market has done a few things in the last sometimes. But it is also not a place which I think should be abandoned.
Taher, hi, good morning. So what do you do if you've picked the right stock, right? I mean, you just have all of the big mid-cap gainers on your screen, whether it's something like a Polycab, which has doubled this year. Titagar Rail is up 270% this year. Zentech, Jupiter Wagons, some of the others, GMR Power, MMTC. If you pick the right stock where you've got 100, 200% returns, do you book out now or do you continue to play this game for the long haul? Because I'm asking because now it seems like there's some amount of euphoria that has kicked in.
No, definitely. So obviously, we have several situations even in our portfolios where stocks have done things which we have expected to happen in the next maybe 8 quarters. They have done it in 3 quarters or 4 quarters. So obviously, we have to be cognizant of that. It's much easier to do this at a portfolio level. So you always have pockets which have probably underperformed. And you always have the option to rotate some of your weightages or some of your positions into some of the underperformers. And there are quite a bit of that as well. So it's not that everything has done very, very well. There are parts which are not performing too or have underperformed as well. So there are opportunities. Second is that you assess them from the point of view of while the evaluations are, like as I said, if they've come too high and too heavy, but are there chances of earning surprises coming your way? And you don't have a choice but to do a lot more groundwork, a lot more diligence in order to figure whether you need to stay put or you need to check out completely or probably take some profits along the way.
Taher, very quickly, we're getting to market opening, but what kind of churn have you all done? I mean, you were talking about a couple of spaces where you can see earning surprises and valuation not too expensive. I can't find too many of them, but if you could highlight a couple of them.
I met a couple of companies yesterday itself in the building material space, and I think what appeared to me was that the demand is a lot more stronger than what we all understand, what we all would anticipate, and it's probably the positive effect of not having a good monsoon, because your construction related activity is probably at its strongest even during July, August, September, and that's driving the demand. So there are pockets like that. We've found places in healthcare. There have been certain situations or opportunities in the manufacturing space, both the industrial manufacturing as well as consumer manufacturing, consumer electronics manufacturing. So those are the kind of spaces that we have probably been able to identify ideas in the last 3 to 6 months. They've done well. I mean,
Tahir, we're coming back to you.
Yeah, we'll just come back. Sorry, we'll just come back to you in a minute.
Taher Badshah, of course, is with us, and we've been talking about what's happening in the mid-cap, small-cap space. Do we have Pankaj with us as well? Pankaj Tibrewal is... Okay, I think we'll give it a minute, and we'll introduce Pankaj as well into the conversation. Taher, so you were saying, right? You were saying you met a fair bit of building material companies, so you're more constructive generally, right, Taher? Yeah. So just tell us, I mean, it's very stocked. Is this also the case that some of the themes which are doing very well, they only find decent representation in smaller mid-cap companies? Is that one reason why one kind of should look at the space more favorably?
No, I don't think that is the case. I mean, like as I said, Prashant, I mean, I don't want to lose sight of the economic backdrop that we are currently in, and therefore it is our job as managers of money to probably find opportunities which will be beneficiaries of this cycle. And I think genuinely you called out a few places where there is interest which is coming back, like for example some of the consumption related names, QSR pockets that we mentioned which have underperformed. There is technology which is kind of underperformed, and they could interpret that as value. The key is how to manage this without taking undue risk in your portfolios. I know that there are a good number of pockets of the market which are doing very fancy things in a very short period of time. It's up to your own risk appetite in terms of how you want to deal with those kind of names. So I think it's important, at least for us as managers of public money, to be cognizant of risk as well, and take our chances or take our bets accordingly.
Yeah. Taher, we have Pankaj Tibrewal also joining us. He's, of course, a fund manager with Kotak AMC. And you'll want to hear Pankaj weigh in on the debate as well. He's on the cautious side. He's clearly on the cautious side. Pankaj, I don't know if you heard Taher weigh in. He basically was saying that he doesn't want to look at indices themselves because they may lead you to wrong conclusions. He's looking at the economic cycle itself and where we are in the economic cycle, and that leads him to believe that perhaps, there's more to go. He didn't say it in so many words, but I'm kind of expressing that view on his behalf. But he's constructive. That's the message. So explain to us, Pankaj, why you are kind of cautious, especially in the small caps, micro, mini caps, etc. Go
on. Good morning, Prashant. Yes, from a medium to long term, if you look at the data perspective, last 10 years, small cap has given 21% CAGR and mid caps have given 19% CAGR. And they have outperformed Nifty by a wide margin. So from a medium to long term, they continue to be wealth creating and one of the best performing across all equity classes. But our view is that cycles have become shorter and sharper. And to survive in the long term and create wealth in the long term, we need to be cognizant about the near as well as short term. And there we believe that mid and small caps, we need to be a little careful and cautious. And there are certain indicators which are pointing towards that. Number one, if you look at the earnings yield of large, mid, small, of across all profitable companies in all the three indices, they're almost trading at the same earnings yield. And for all your viewers, earning yield is nothing but 1 by P. And when you look at the earnings yield across the same segment, why to take additional risk in mid and small caps where the mortality rate is much higher than large caps? That's number one. Number two, if you look at, there's a disconnect between the profit distribution and market cap distribution right now. So mid and small caps as a percentage of, free float market cap is about 31%, nearing all-time highs. And when you look at the profit distribution, the top 100 companies of India, which are large caps, constitute 75% of profits, and mid and small cap constitutes 25% of the profits. So there seems to be some disconnect on the profit distribution versus market cap distribution as we see today. Third, if you look at the flows, has been extremely strong. And I think we need to be careful that people are looking at rear view mirror, looking at the past 3-year, 5-year, 10-year returns, and probably assuming that mid and small caps are the way to financial nirvana. But our advice is that please don't make mistakes right now, because somewhere 2017 still seems to be fresh in minds of all of us. And mistakes made in 2017 actually had repercussions in 2018 and 19. When I look at the entire space, yes, there are pockets of opportunity, but in the near term, we see that many market participants are focusing on more on P&L rather than balance sheet and cash flows. And that's something which needs to be worried about. And hence, a lot of flows are coming to mid and small cap funds. In the last 6 months, more than 30,000 crores have flowed into mid and small cap funds. We have seen 1.9 million new folios being opened in small cap funds, and they are above their historical averages in terms of valuations. So yes, from a mid and long term, we continue to be positive, but there seems to be some kind of greed which is clearly visible in the near term, and one needs to be careful about it.
Got it. Absolutely. I agree completely that, there is some amount of euphoria that's kicked into the market. But Pankaj, very quickly, I mean, if you can, tell us what are the pockets that you feel one should move out of? I ask because there's so many that are doing well now, whether it's, defense, whether it's some of the power names. You have sugar that has come back in a big way. Which are the spaces that you feel are just fads at the moment, and perhaps you should book your profits if you have them?
Sonia, history always repeats itself, and we should not forget the learnings from the past. And the past cycles have suggested that what are the pockets one should avoid in this euphoric zone? One, as I mentioned, people are looking more at profit and loss account and probably not giving too much of focus on balance sheets and cash flows. I see many sectors, companies where they have not generated cash flows for a long period of time, even operating cash flow. Those stocks are trading at crazy multiples just because the narrative for the medium to long term is very strong. I think one needs to be careful about that. Second, I am seeing a lot of sectors and companies where working capital tends to be very high. But today, the order inflow is so strong that people are not worried about working capital. Third, many sectors, companies where return on capital is lower than the cost of equity. I think people are getting excited, but sustainably we have seen that these pockets should be avoided because from a wealth creation perspective, they are not the ones to bet on. So I think classic, same, investment philosophy we need to follow and make sure that we don't carried away by momentum in the near term. I think right now, quality anchoring is the most important part. Rather than worrying about too much of upside, I think one should be careful about downside protection, how the portfolio will behave if there's a drawdown or a consolidation in the market for a slightly longer term. Don't forget, calendar year to date, Nifty is up 9%, Bank Nifty is up 3.5%, but whereas mid and small caps are up between 27 to 30%. And many stocks, we have seen them multiplying. Money making can't be so easy. And hence, we believe that near term, one needs to be disciplined on asset allocation.
All right, Pankaj, very valid points out there. Just want to confirm that one number, mid and small cap as a percentage of free float market cap is at 31%, but their profitability is accounting for 25%. Did we get that number right?
Absolutely. Absolutely.
All right. Okay. All right. Pankaj, I want to come back to you to ask you what you're bullish from here on, because clearly you're sounding a little bit cautious. But before that, let me go across to Taher. Taher, you're quite constructive, and we got, the spaces that you're constructive on. But where would you be a little bit cautious? And then we'll go across to Pankaj to get where he is bullish.
So in the same sector, you probably have opportunities which are not as, expensive. And then there are, certain stocks in the same sector which are at the other end of the spectrum. So, it's not that one sector is very expensive and one part of the market is very expensive and everything else is relatively cheap. But you find, so we don't have a choice but to probably, even try and rotate within the sector itself. So even in something like consumption, we'll find those kind of opportunities. There are some parts of urban consumption-led ideas or stocks which are doing, which while they've demonstrated performance, but the thing is that they're trading at excessive valuations, whereas some of the others, which are more, let's say, value-oriented, are not doing as well. Same applies in the case of the industrial space as well. So while we like the cycle, but then there are some which are, as even Pankaj mentioned, where we've seen extension of balance sheets and where we probably don't see as much of cash flow, and even they are doing very well. Whereas there are others which are supported by reasonably strong order books and probably will see better growth or outcomes and maybe even surprise in earnings. So I think we are just trying to dissect them within their respective spaces and take decisions accordingly.
Okay. All right, gentlemen, Taher and Pankaj, thank you so much for stopping by. I appreciate your thoughts. And it's important you guys make the point that, despite the rally that we've seen in the mid and small cap space, I think the time has come to become a little cautious as well, because anything and everything is rallying. So you don't want to burn your fingers. That's what history has taught us, right? Thanks a lot for
Sonia,
that sane advice.
Can I just say
sure, of course.
just one quick point? Can I ask Anurag, our producer, to pull up that small cap valuation graphic? Pankaj, this is for you. I just want you to very brief response to this. So you put out so much rich data, right? Interesting data, which kind of points to the need for caution. So this is simple valuation data for small caps. Can we have the data up? Yeah, there you go. So let me just read this out to you, Pankaj. So I just looked at small cap the Nifty small cap index, 1 year forward PE multiple, right? Where it is now as compared to the previous significant highs. As of yesterday's close, the 1 year forward PE multiple is 16.3 times. The last significant high, top, was October of 2021. We were at 23 times. We're at 16.3 times now. Back then, in October 21, we were at 23 times. And before that, the significant peak, the one that you were mentioning earlier, 2017-18, the small cap 1 year forward PE multiple was 14 times. So we are above 2018 levels, but significantly below the October 2021 levels. Just a 30-second response. I mean, how to think about these numbers, Pankaj?
So you are looking at the forward P, Prashant.
Correct.
When I look at
Correct.
the trailing earnings yield, today small caps are trading at a slight premium to large caps.
Okay.
And the trailing numbers are what it has been reported. Forward is our opinion, right? And in the index, don't forget that there are a lot of companies which are moving from loss to profit. And hence, on the headline basis, it could be slightly misleading. Because unlike large cap index, where there's hardly any loss-making companies, in mid and small caps, there are many loss-making companies, and some companies are moving from loss to profit. And hence, the headline valuations could be a little misleading. We need to go into a little detail rather than looking at the headline valuations, what you have been on a forward basis. That's a caution I would make.
Perfect. Excellent. Makes sense. Thank you. I just wanted your response to that, and that makes so much sense. Thank you very much once again, Pankaj and Taher. Great discussion. Both of you, appreciate your time here on CNBC-TV18. Sonia.
Absolutely.